Welcome to Talk Tickers. Today we are doing a deep dive into, well, a really fascinating earnings report, Ambev SA, ticker ABEV, after their Q3 2025 call.
Yeah, fascinating is the right word. This wasn't just straightforward results. It felt more like management walking a tightrope over some pretty disappointing sales figures.
But they stuck the landing, didn't they? It was kind of a masterclass in controlling the narrative.
Absolutely. The call was October 30th, right? Smack in the middle of U.S. trading hours, and the market reaction, immediate, powerful.
Which is wild because if you just looked at some of the numbers in isolation.
Exactly. Despite some misses, the stock traded up, 3 to 5% during the day, and it closed up about 5.5%. So our job today is really to unpack how they managed that. Why did the market cheer margins over actual volume growth?
Okay, so let's set the scene first. The big picture, definitely mixed, but the story they told, the qualitative win, was all about execution. Look at the headlines. Adjusted EPS came in at $0 or $4. Okay, that hit consensus. A decent floor, you could say.
Right, met expectations there.
But then, the top line, revenue. It landed somewhere between $3.83 and $3.90 billion. And that flat out missed the consensus range. Analysts were looking for closer to $4 billion, maybe a bit more.
Yeah, $3.97 to $4.03 billion was the range. So a definite miss. And normally, for a company like Ambev, a revenue miss like that, especially now, that could spell trouble.
Big trouble. But here's the twist, the thing that completely changed the story. Net profit, reported in Brazilian reais, it just soared, are $4.86 billion.
It's a huge number. That's up 36.4% compared to last year.
Yeah.
And the consensus, they were expecting something like R$3.19 billion. Ambev absolutely crushed that.
Crushed it. So, softer sales, record net profit. The math points to some serious leverage somewhere.
Well, certainly wasn't volume helping them out, that's for sure.
No kidding. Volumes were actually down pretty significantly, too, between 5.8% and 5.9%.
A nearly 6% drop in volume.
Yeah.
That's a major headwind. And that's what makes the next number just so critical. Adjusted EBITDA. It came in at $7.06 billion.
Which was still up organically.
Yeah, up 2.9% organically. And here's the kicker. They delivered a 50 basis point margin expansion.
Okay, that's the key. Selling almost 6% less beer, but actually increasing your margin per unit.
Exactly. That signals a kind of fundamental strength, or at least incredible discipline, that the market just loved, instantly cheered.
All right, so that margin expansion, we really need to dig in there. It feels, almost counterintuitive with that kind of volume drop. How much of this was like real structural strengths versus maybe some short-term fixes?
That's definitely the right question. And the strength wasn't just about cutting costs, though they did that. It was really about successful pricing power.
Okay.
The metric to watch here is net revenue per hectoliter in RHL. That grew by a really strong 7.4%.
Wow, 7.4%.
Yeah, that's probably the clearest sign that they were able to raise prices effectively, and maybe even more importantly, that their product mix shifted towards more expensive stuff.
So premiumization is paying off.
Hugely. That 7.4% NRHL growth basically swallowed that nearly 6% volume hit whole.
So making a significantly more profit on each beer sold, that's the premium effect. But it must also mean, like you said, incredibly tight cost control, too. Management kept saying consistent execution.
They did. And their cash cost of goods sold to COGS came in better than people expected. They gave some specifics, too.
Like what?
Well, they mentioned SKU rationalization, basically, simplifying the product lines, cutting the slow movers, and also optimizing the use of their vertical operations.
Okay, explain that second one. Optimize utilization of vertical operations. For people maybe not deep in beverage manufacturing, what does that actually mean for Ambev?
Well, it's a massive advantage for a giant like Ambev. It means they control more of their own supply chain. Things like maybe their own glass plants or malting facilities.
Gotcha.
So when they optimize utilization, they're basically running their own internal factories and equipment closer to full capacity, more efficiently. It lowers the cost to produce each bottle or can.
So they're pulling levers deep inside the machine to protect profits when sales are soft.
Precisely. It's real operational discipline.
Okay, so that's the operational side. But then came maybe the biggest signal of confidence, the capital allocation move. They basically promised a ton of cash back to shareholders.
Oh, yeah. The board approved a huge new share buyback program, up to 208 million shares.
Which is worth?
About our $2.5 billion, give or take. And it's over the next 18 months. That's a massive commitment.
Especially when you're facing these like short-term macro headwinds.
Exactly. When management sees challenges but still puts that kind of capital towards buybacks, it screams confidence in their long-term cash generation. They're essentially saying, we think the stock's cheap and we believe we'll keep making plenty of cash.
Okay, now, we have to get into the weeds a bit here because there's a critical piece that explains how that net profit beat was so massive. The tax rate, the ETR.
Yes. This is where things get, let's say, a little distorted. It's like looking through a financial funhouse mirror for this quarter.
What was the number?
The effective tax rate was just 6.7% for Q3.
6.7%. That's incredibly low. What was it last year?
It was 23.6% a year ago. So that massive drop, that is the single biggest mechanical reason for that stunning net profit number.
Okay, so we absolutely have to understand what caused that drop because it sounds like it might not stick around.
It won't. Management was quite clear these were non-recurring items.
On-offs?
What were they? Three main things, basically. First, they partially reversed a tax liability they previously set aside. Second, they recognized some specific fiscal incentives. And third, there was a non-taxable gain from selling their Barbados operations.
And those added up.
Those one-time benefits were about our $630 million in total.
Our $630 million. Okay, put that in perspective. If you strip that out, that our $4.86 billion net profit suddenly looks a lot less dramatic compared to expectations, doesn't it?
Dramatically less. It really highlights how much that headline beat relied on these temporary tax items.
Did management give guidance on what the rate should be?
They did, thankfully. They confirmed that without these one-offs, the ETR would have been much closer to 20%.
20%, okay.
So yeah, this clicks 0.7% ETR. It's a one-time gift. Anyone modeling Q4 or, looking out to 2026 needs to plug that ETR back towards 20% right away. It's not repeatable.
That is a super important caveat. Okay, let's swing back to the operations then. That volume decline, nearly 6%. Management really tried to frame it as situational, not structural. Was that just spin or is there actual data behind it?
Well, they did provide a pretty detailed breakdown. The CEO basically argued that the softness, especially in Brazil beer, was mostly situational. They estimated about 70% of the industry's decline was directly tied to, unusually cold and rainy weather.
Where?
Mostly in the south and southeast regions of Brazil.
Which makes sense. I mean, beer drinking definitely goes up when it's warm and sunny, especially outside.
Exactly. And they were comparing against the last two winters, which were apparently the warmest on record. So a really tough comp. Fewer barbecues, fewer big outdoor events that hits the mainstream brands the hardest.
Okay, so 70% weather. What about the other 30%?
That part they attributed more to consumer purchasing power being squeezed, especially affecting the north and northeast regions, which tend to be a bit more price sensitive.
So the argument for management is weather normalizes, volume stabilizes, don't worry about structural decline.
Pretty much. They're saying, brand health is good, consumer engagement is there, this is just a temporary blip caused by Mother Nature, mostly.
And the regional results kind of showed that pressure on Brazil beer.
They did. Latin America South, or LAS, actually had strong net revenue growth, up 9.2%. And COC Central America and Caribbean was up 2.2%. But Brazil beer, net revenue there shrank by 2.1%, purely because of that volume pressure.
And this is where that premiumization strategy really rode to the rescue.
It's the superhero cape for this quarter, absolutely. It allowed them to offset that core weakness.
So how strong was the premium performance? It feels like it's becoming a real structural advantage for them now.
It's definitely the engine of the business right now. Get this. Ambev reached nearly 50% market share in the premium and super premium beer segments.
50%? Wow.
Yeah, their highest share in that high-end space since 2015. Brands like Original, the Stella Artois family, Corona. Collectively, their volumes grew over 9%.
So while total volume was down almost 6%, the fancy stuff was up 9%.
Exactly. That 9% growth in high-margin beers was the literal counterweight. It's what allowed the overall margin to actually expand despite selling less beer overall.
And they're leaning on their digital ecosystem too, right? That helps with pricing and promotion.
Oh, hugely. Gives them incredible agility. Their B2B platform, BE marketplace, the gross merchandise value, GMV, it doubled year over year. It's now running at an annualized $8 billion.
That's a massive scale.
It is. And all that data lets them do really granular stuff, like testing price elasticity almost in real time, figuring out which promotions actually work.
What about the consumer side? Zed Delivery.
Also strong momentum there. The average order value, the AOV, was up 9%. So even with consumers feeling squeezed, the ones ordering direct were actually spending more per order.
Which probably ties back to that premium portfolio again.
You'd have to assume so, yeah.
Okay, so let's try to synthesize this. Why did the market reward the stock so much, even with that top-line miss? What was the core message they received?
I think the market's focus just shifted decisively. Investors seem less worried right now about immediate volume recovery because that depends so much on the economy, on weather, things Ambev doesn't fully control.
Right.
Instead, they focused entirely on the margin defense and the cash returns. Seeing that 50 basis point margin expansion, plus the massive $2.5 billion buyback, that just signaled strong management, capital discipline, protecting the profitability floor.
And part of that protection also came from keeping SG&A costs in check.
Correct. Selling, general, and admin expenses were tightly controlled. They even mentioned, interestingly, that part of the admin cost control came from adjusting variable compensation accruals.
Meaning?
Basically aligning bonuses and pay expectations for executives and employees with the tough year they were having. It shows they're looking at every single line item to protect that bottom line.
Makes sense. And looking forward, any specific guidance?
No hard numbers. Management kind of stuck to the script. Keep investing in the brands, especially premium, and keep being ruthless on costs.
So near-term things to watch are probably the pace of that buyback actually happening and, of course, how the holiday season shapes up for sale.
Yeah, it's a pretty classic playbook for a strong consumer staples company in a tough spot. Maximize the value from the customers you have now, generate cash, return it to shareholders, and just position yourself to really accelerate when the macro environment gets better.
Okay, so given this big jump in the stock after the call, we have to ask, maybe the market got a little ahead of itself. Which brings us naturally to our This Is Not Financial Advice segment. Time for an outrageous but plausible trade idea.
All right. The stock definitely popped, like you said, 5.5%.
Yeah.
And it felt like it was almost purely fueled by that margin story and the buyback news.
Exactly. But a big chunk of that good news, specifically the massive profit beat, was heavily juiced by that temporary 6.7% tax rate. That's not coming back.
Right. It's non-recurring.
Plus, the CEO himself said the weather headwinds the thing, causing 70% of the volume drop they continued into October. So the volume pressure isn't necessarily over yet.
Okay, so the long-term story, premiumization, digital, that still looks pretty solid.
Agreed. But short term, Q4 results, Q1 next year. The tax rate will normalize back towards 20%. That automatically removes a key driver of this Q3 beat.
So you're thinking the stock might have run up a bit too fast on temporary good news?
Potentially. So here's the outrageous but plausible pitch. Consider initiating a bear call spread on ABEV options. Maybe targeting, say, Q1 2026 expiry.
A bear call spread. Okay, what's the logic?
The logic is, the stock might have hit a short-term ceiling based on news that won't repeat the tax benefit. The inevitable normalization of the ETR, combined with maybe some continued weather uncertainty or volume sluggishness, it could create some technical resistance for the stock in the near term.
So you're not betting against the company long term?
Not at all. This spread lets you potentially collect some option premium from the recent volatility spike, essentially betting that the stock won't surge dramatically higher in the very near term without going full-on bearish against the fundamental value. It's a hedge against maybe short-term overenthusiasm.
Interesting. A way to possibly capitalize on the mechanics of the Q3 beat, not just the strategy itself.
Yeah.
Okay, so to quickly recap our deep dive then, Ambev faced serious volume weakness, but they pulled off a win in the market's eyes.
Yeah, they successfully defended profitability, signaled real confidence through strong pricing, tight cost control.
And that very substantial share buyback, it was really a victory of financial discipline managing to overcome those operational headwinds, at least in terms of market perception.
For sure, yeah.
But here's the provocative thought we want to leave you with. Ambev's success in premium and super premium is just undeniable. They're nearing 50% market share there, which is huge.
Yeah.
How much higher can that realistically go? I mean, can they push that premium mix much further before they start hitting serious price resistance from consumers, or just simply run out of market share to gain at the high end? Especially if the economy stays constrained. They're already dominating there. Chasing that next 5% of mix, that might be the real uphill battle over the next few years.
Something to definitely mull over, especially as we watch those Q4 weather reports. All right, thank you for joining us for this deep dive into Ambev's Q3 results. We'll catch you next time on Talk Tickers.